So ever since the financial crisis, global central banks have tried to support struggling economies with financial stimulus, like low interest rates and quantitative easing. But as these economies have slowly begun to heal, central banks face a tough decision. How do they scale back this financial stimulus and normalize monetary policy without upsetting economies and creating a sharp slowdown in growth? Economies are stronger, but just how strong remains a difficult question. And that's particularly true in the UK, where the economy appears to have slowed during the second quarter, and where the Bank of England is concerned not only about inflation, but also about rising debt levels. In the Eurozone, the economy has been a little bit stronger, and that's given the central bank some opportunities to think about scaling back stimulus. And in the UK, where the central bank cut interest rates in the wake of Brexit, inflation is still above its 2% target. The usual answer might have been normally to raise interest rates, but the governor, I think, and the Monetary Policy Committee are a bit loath to do it, given where growth is at the moment, and given the fact that this is really a function of sterling weakness rather than anything more profound. And we see that in terms of wage growth, where real wage growth remains negative. It's earnings season, which means global companies are releasing their results to show how they've performed. Now, it's not just the overall level of earnings that people look at, but how these companies are performing relative to expectations. It's still early days, but so far results are decent. In the US, more companies are beating expectations than missing them, and in Europe it's about balanced. Maybe the recent strength of the euro is partly to blame for some of the misses that we've seen. Now, warnings that equity valuations look stretched aren't new, but we'd argue that with earnings coming through more or less the way we'd like to see them, that should be supportive for equities at this point. Global markets are experiencing historically low levels of volatility, and asset prices have been relatively stable. In fact, in the US, they've experienced some of the lowest levels ever recorded. Now, this might seem like a good thing, but is it really a fair reflection of the risks that we see in markets today? Our markets may be not registering some of these risks and some of the concerns that we can see at the policy level, at the valuation level, and so on. Are markets too comfortable with the idea that central banks will always be there to provide liquidity? And when central banks decide to normalize monetary policy, what impact could that have on the overall levels of volatility in financial markets today? Now, we'd argue that one thing to guard against is the temptation to take on more and more risk just because volatility in recent times has been so low. The question is really one of sustainability. Will these levels of volatility that we've seen in financial markets really sustain far into the future?